Hi there, folks. This is Mark Weissy from Maple Capital Partners. And in the video today, we're going to be going over the STR market. That's short for the short-term rental market. A lot of folks are familiar with apps like Airbnb, Expedia.com, Booking.com. These are all different platforms on the short-term rental market. And it's basically renting out spaces to individuals for shorter term than would otherwise be the case. Hospitality, hotels, that's a market that we're all familiar with. And this is basically democratizing that hotel market. It's providing the ability for individuals like you or I to be able to list our houses, second houses, or even rental property on Airbnb. So it's been massively transformational the last few years. I'm sure that's not news to anybody, but we're going to dive into today the STR outlook for 2024, as well as a little bit about where we came from in 2023. The reason why I'm delving into the STR market is because right now, multifamily is incredibly expensive relative to the cost of financing, relative to the operating expenses going up over the last few years. And the cap rates compared to the cost of leverage, the cost of capital is very, very slim. So for that reason, we're exploring other asset classes, really learning, investigating those asset classes and developing relationships with operators in those asset classes to maybe one day pursue opportunities there. And so one of those such asset classes is short-term rentals, where you can still make pretty massive cash from cash returns and with the long-term possibility or opportunity to add value. So we're going to get into it. Today, I'm going to be breaking down the AirDNA report that shows their outlook for 2024 based on the data that they get. AirDNA is one of the premier data providers in this space. They collect data from the platforms I listed before and many, many more, and they use that to create insights for investors in the STR market. Now, I just first want to add a couple of caveats when I'm talking about this report. Two things to keep in mind are, one, a lot of this is based on industry averages, so it's going to be completely agnostic to both operators and geographies. So as we all know, the operator can make or break a deal. That is the owner of the particular asset, has the ability to really strongly influence the returns. And so this is an industry average, and that's going to mean that we're looking at returns on an average basis, not best-in-class returns, and also not the lowest returns. So that's one thing to keep in mind. The other thing is the geographic picture. So because of the fact that this pulls data from across the U.S., we're all familiar with the fact that real estate is a hyper-local asset class, and because it pulls data from across the nation, there are going to be a lot of different signals that may or may not be noise, because one market is not going to behave like another one, and so a lot of stats that are derived from that data may not be as useful to your particular market. But I just want to kind of start off with those caveats. One thing that we're going to touch upon is the so-called AirBn-Bust as well that occurred in 2023. And that's basically the idea that Airbnb has become very saturated over the last few years in many markets. And so many operators, many owners, they're seeing a lot of their stats related to the performance of their properties decline. So they're seeing occupancy decline, they're seeing RevPAR, that's revenue decline essentially. And so how does that really set the stage for performance in 2024? So first of all, before we start in 2024, let's take a look at the 2023 year in review. So first of all, I want to talk about the good. One of the good things that came out of this report is that there were a record number of nights demanded in July. That is nights that were booked. That's the highest ever for any month. Prior to that was July of 2023. And that's a really strong indicator that consumers are traveling, they're spending, and ultimately driving the STR market. Also, there was a persistently strong U.S. economy throughout much of 2023. That defied a lot of what economists were calling for in 2022 and 2023 first half, when a lot of them were saying that we were headed towards recession and that our economy was going to be flatlining, and there was a discussion about hard versus soft landing. And so the unemployment rate, though, did stay below 4% for the entire year, and inflation has steadily come down from what was in 2022. I believe we were close to 8-9% on certain months, to now closer to 3%. And that's getting pretty close to what is a somewhat, quote unquote, normal inflation environment of close to 2% is what the Fed targets. Also, one other good indicator that we can look at is Airbnb earnings. So Airbnb is the largest provider of the short-term rental stays. And so as a result, following how they're performing from their earnings standpoint is going to be a really good signal to us about how the overall hospitality market is doing. Their Q4 nights booked grew 12% over the prior year. That year-over-year growth was also compounded by the fact that the number of first-time bookers grew during Q4 of 2023. So first-time booking is basically somebody who wasn't using Airbnb prior or didn't have a Airbnb login and they set one up and then they booked their first night. That grew in Q4 of last year, and that was actually the highest quarterly rate of growth for first-time bookers ever experienced by Airbnb. So a lot more folks are becoming aware of Airbnb, are using the platform, not just domestically, but also internationally where they're pushing. And so all that's going to be the good news. Now, what about on the bad side? For 2023, many markets became more saturated. As I mentioned before, that AirBn-Bust term came to prominence in 2023 as the supply of new listings approached over 1.6 million by September of last year. That's really a function of a lot more owners coming online, a lot more private operators coming online and starting to list units. And so that supply growth was coupled with the fact that we had tightened consumer budgets. I talked about inflation just now, but that inflation has really led to consumers being a lot more cost conscious with their spending. And one of the places where they can do that is in their travel every year. And that was exhibited in the fact that RevPAR, that's revenue per available room, actually declined for the year 2023. And that was the first annual decline of RevPAR since 2014. It actually dropped by close to 5% in the US. So not only did the revenue dry up, but also demand growth slowed. So we still saw the number of nights booked grow, but that rate of growth actually slowed. It was attributed in the report to a number of different factors. It was the economic uncertainty, several large natural disasters, including Hawaii and Canada, which I'm sure many of us heard about last year, as well as the effect of inflation reaching the generational high and the impact that that has on consumer wallets. Also, consumption trends in 2023 meant that more US consumers traveled abroad for vacation and travel domestically. One thing that we saw coming out of COVID was a lot of US consumers and folks based in the US traveling domestically. And so, you had a lot of the markets domestically growing like crazy, whereas international travel really lagged. And now that trend is starting to reverse, where a lot more people are feeling more comfortable with traveling internationally again, and the kind of return to normalcy trend is continuing here. So the domestic location STR demand was up about 4.5% year over year, while the international STR demand was up 17% year over year. So again, that's just kind of the fact that people are more comfortable traveling further. Okay, so that was a 2023 year in review for short-term rentals. Now, as we're looking forward, one thing to keep in mind is so much of the short-term rental market is driven by the overall macro economy. Now, our economy is consumer driven. 70% of our GDP comes from the consumer. And so the jobs picture, the wages picture, the inflation picture, all these things, future expectations are all going to weigh into people's decision whether or not to travel and where to travel. So I'm going to go over what was pointed out in the AirDNA report, and we'll use that to make sense of what they're projecting for 2024 in the short-term rental market. So first of all, as I mentioned, the long-awaited recession never materialized. The Fed's rate increase regime started in 2022 to combat inflation, and its efforts seem to have been effective. The inflation rate dropped from 9% in June of 2022 to a current rate of the mid-threes. So that's obviously a success as far as the Fed is concerned. They still have more work to do, but inflation is coming down. Now, while recession was likely, the economic retraction didn't happen ultimately, and the economists at AirDNA believe that there were two factors that mitigated that effect. Those were diversification and savings. They say that the current economy is more diversified than the last one, which experienced such inflation rates in the 1970s. And today, much more of the economy is not interest rate sensitive or as interest rate sensitive as it was during the 1970s. And so regardless of where Fed sets rates and where mortgage rates are and cost of money, basically, many industries have been able to somewhat be resilient in the face of that because of the fact that our economy is diversified relative to where we were in earlier times. Now, in addition, there were considerable excess savings, which were fueled by federal stimulus during prior years post-pandemic, and that helped keep spending and employment consistently high throughout 2023. In fact, employment remained strong throughout the year at 3.7%. The unemployment rate is showing that the labor market is still very, very strong. We're at a level that most economists call full employment, where that basically means that anyone looking for a job can find one reasonably. And as a result, competition for labor is quite high. And that means that that competition is driving wage inflation, something that we were looking to see in earlier years, but this has meant that wages have grown basically because more employers are having to compete for fewer employees. And with those wage numbers going up, we're seeing more consumer spending. It just makes sense. As people make more money on an after inflation basis, on a real basis, they feel richer, they want to spend. That's something known as the wealth effect in economic circles. Now, looking forward in terms of economics, the AirDNA report seems to project forward that inflation, they're pegging inflation to stay fairly elevated until the end of 2024. And that means that rates will likely stay high by their estimates until they see inflation come down to closer to the 2% mandate the Fed has. They're also calling for a housing market decline somewhat, a slight decline that is in home prices, with mortgage rates being elevated or expecting to remain elevated. And so as the cost to own a home or buy a home has gone up, housing prices should understandably kind of creep down. Affordability right now, they mentioned affordability quite a bit. They're saying that affordability is at an all-time low, meaning that new supply of Airbnbs is likely to remain subdued for some time because of the fact that more people can't buy homes. Competition for homes is fierce, and that's driving down the likely new supply of Airbnb. Now that we've covered AirDNA's economic outlook, and I have to say that I agree with their projections for what it's worth, now let's look at what AirDNA is projecting for the 2024 outlook in the national STR market. First of all, on the demand side, they're calling in 2024 for economic growth and recovery in domestic travel, and they're saying that that's going to reaccelerate demand growth to around 10.7%. That's a huge number and more than double what it was last year. Now on the supply side. On the supply side, AirDNA seems to point to the fact that there are high mortgage rates, and soft per unit performance means that there will be likely less supply going forward, less supply growth, I should say, going forward from the extreme highs that we saw in 2022, where you had just tons of units coming online in the STR space to meet the growing demand. But today, that's likely to be different. And for 2024, they're expecting that performance will return to long-running averages and bring supply growth closer to that 10.9% in 2024. And that'll strike a better balance with the growth in demand, which is 10.7%. So they're basically calling for kind of a plateauing or a stagnation of growth because of the fact that you have supply growing at 10.9%, you have demand growing at 10.7%. And so we're approaching a market, at least on a national basis, that's more in balance. On the occupancy side, they're saying that occupancy has been steadily falling since the highs seen in 2021. And by the end of 2023, the yearly average will come in approximately around the pre-pandemic level of 54.7% occupancy, about the same as it was in 2023. Again, that's most to say, or most to categorize 2024 as a year in which supply and demand balance. Now, what about on the ADR side? That's average daily rate side. We mentioned before, but travelers are becoming much more inflation weary. Their wallets have felt a squeeze in the last few years, and they're looking for affordable options to keep their travel costs down. So that's kept rate growth to only about 0.5% in 2023. And as changes to the price level normalize in 2024, so too will ADR growth. They're expecting that ADR should increase by around 2.1% in 2024. On the RevPAR side, it's much of the same, where 2024, they're expecting to see RevPAR, which is revenue per available room, rise by 1.9%, thanks to steady occupancy and a 2.1% increase in ADRs. So what does this all mean? Well, we believe that Airbnb and short-term rentals in general are approaching a point of maturity, a point where supply and demand, as mentioned in the report, are coming more into balance. And so it's going to be super crucial for you as a short-term rental operator or a prospective short-term operator to really understand your market, where the demand lies for your market, and how you can be different. For a lot of the STR operators that we speak with, what they're saying is that the people that are succeeding in today's market, as opposed to the market of 2022 or 2021, are folks that are doing things a little bit different. They're offering experiences that are unique, spaces that are unique, and memorable. Really what people pay for, especially so today where people are super crunched in terms of their budgets, is something different. They want a memory that they can, return back to years later. And so, for STR operators, you really, as opposed to multifamily, you really want to stick out. In the multifamily world, you don't want to be a pioneer. When you're doing a value add business plan, you want to look at what's out there in the market. You want to more or less come in line with that in terms of the features that you're offering. However, on the STR side, you're a lot more rewarded for being creative in terms of the type of product that you offer. And so we're seeing that a lot of the operators that are best in class in this space are offering just premier products. They're either going up in luxury, offering more for certain price points, or offering unique features that you just can't get in their markets. And so what we're looking for in 2024 as it pertains to STRs is we believe that while revenue has fallen the prior year and that supply growth is now stagnating, that this could be a really good entry point for savvy operators or folks with capital and courage to come into the market and start to look at maybe where they can pick up some opportunities, some value add opportunities to create some of these unique experiences. So we're going to keep our eyes open. We do believe that there are good fundamentals in place for a strong 2024 in STRs. And we're going to keep looking there. We just got back from a trip to Puerto Rico to evaluate some of these opportunities, and hopefully we'll have more to come in that respect in future videos. Thank you. I hope you've learned something from this, and I'll put the link to the AirDNA report in the description for this video. I'll sign off as we always do at Maple Capital Partners. Be kind, be charitable, and invest wisely. Thanks, folks.